Improving Alpha Innovation in Investing, ESG and Technology with Michael Oliver Weinberg, in partnership with Vidrio Financial, is being sponsored by Alternatives Watch, providing a 360-degree view of investor mandate activity across alternative investments, and PEVC Tech, a community for family offices, private equity funds, lenders, and VCs using AI and analytics to generate alpha. Vidrio Financial is a premier data management provider shouldering the responsibility for your data from collection to extraction, transformation, and enrichment. Vidrio monitors over 2,000 diverse funds, processing millions of data points each month. Discover how Vidrio empowers your institutional portfolio data by combining advanced AI and human expertise to yield comprehensive analytics on performance, cash flow, risk, valuation, and more. All delivered seamlessly through Vidrio's Data Management Hub. Save your investment team valuable operational time, providing actionable insights like never before. Explore more at vidrio.com.
Hi, this is Michael Oliver Weinberg. We'd like to welcome everyone to the Improving Alpha, Innovation in Investing, ESG, and Technology podcast series. Today, Shivaram Rajgopal, fellow Columbia Business School professor, is our expert. So listeners have a high-level sense of our roadmap. We will start with some background, then discuss innovation with a focus on ESG, particularly governance. Investors and business leaders should be able to extract a great deal of value from Shiva's insight. On that note, welcome, Shiva.
Thank you. Thank you.
Yeah, my pleasure. Let's start briefly with your career evolution to where you are today.
Okay, so I guess as you can tell from my accent, I'm from India. So I spent most of my formative years in Bombay, now called Mumbai, arguably 2 times as big as New York, maybe even more, if you put in the undocumented people there and so on. I trained as a chartered accountant, which is the British equivalent of maybe a CPA, the Indian version. So we spent 3 years going through what we call articleship. It's somewhat close to the clerkship that the lawyers go through here. Then spent about 3 years in Citibank, got bored of working, came here, got a PhD, took me 6 long years at the University of Iowa. And then I've been at various places as a faculty member, University of Washington, quite a few years, and then Duke, Emory, Columbia over the last 9 years.
Great. Let's get right into governance, as you're an expert, and I've had the privilege of furthering my governance and board knowledge from your teachings. Let's start with the CEOs of companies. What % of the time do you think they should be spending cultivating shareholders versus running their companies?
You know, I often joke, as you know, Michael, that the largest shareholder today for public companies is a computer program. What do I mean by that? I think it's passive, like 20-25% of the S&P 500 is owned by BlackRock, Vanguard, State Street. So who does the CEO go and talk to? So the proportion of time question is interesting, but you have to wonder about who does the CEO even go and engage if he or she wants to talk to somebody about strategy. Long-term active as an asset class, I think, is dying or probably already dead. So there's nobody to talk to unless there is some kind of, activism event, like say Disney or Exxon in a different context. Then you talk to a bunch of pension funds and so on. But when you said engage or talk to, I presume you meant in terms of being a partner for strategy formulation and execution. And I'm going to suggest there is nobody on the other side.
You posed the question. So you mentioned the massive percentage owned. First of all, I agree with your premise that active large caps largely passed. I think it's lost that war to indexing and quant, to your point. So we're very much aligned on a similar page there, I think. But I mean, should the index owners have a view though on strategy? In other words, aren't they by definition passive? I mean, isn't that something that active should be doing? So you're nodding your head, but the viewers will now hear what you're visually showing me.
Yeah, I'm a compulsive nodder. I'm sorry. This is my way of acknowledging your comments and question. But so let's think a little bit about this. So you're right. The job of passive is to be basically passive and track the index. So then the question becomes, what is the index maker's job, right? So that's something else we can talk about. So you keep peeling the onion, and then you have to arrive at some decision maker who's deciding what gets into that list. and presumably that's the index maker. So you can have an algorithmic index and you can have a discretionary index. An algorithmic index, at least I know what's going on. The top 1,000 companies, let's say the Russell. S&P, there's a bunch of discretion involved. So where does the buck stop is the question to ask. I mean, you're right. Passive in a narrow sense does what passive is supposed to do. But then it also leaves a vacuum at the macro level, right? So for instance, if nobody is engaged on the other end, it creates all kinds of problems. So for example, I'm on the board of the PCAOB, which is the regulator for the auditors. And we often worry, how come investors are not interested in what we're doing? Because there is literally no one on the other side. You can say the same for the FASB. It tries to talk to investors. Is BlackRock, Vanguard, State Street interested? I'm not sure. So on the one hand, from a narrow standpoint, you're right, passive does what passive does. But from a systemic macro standpoint, I think it leads to worse governance and arguably disengaged investors. Have we effectively made liquidity so easy? You can just get in and out, get in and out. Maybe there's some value to illiquidity because then you have to, and this is the other issue. For example, the Exxon issue that happened yesterday. By the time this goes live, I don't know how long that would be, but folks know what happened. So Exxon is a company that actually sued its shareholders. And I'm not saying whether the suit is right or wrong in terms of scope 3 emissions. We can discuss that. But it's a bizarre incident. And then, people got reelected. The board got reelected. The chair got reelected. Why? Either institutions decided to simply go with management, which is what they often do, with a few exceptions like CalPERS and so on. Or you probably have to do a lot to get fired these days, is the other alternative interpretation of this, right? Is there something called shareholder democracy? Does anybody really engage or care? If folks like CalPERS who probably hold indexes are stuck with these companies, so occasionally they make some noise, just to kind of reel back and take stock of what we're saying here, you're right in one sense. Passive does what passive is supposed to do. It's fantastic for individuals like you and me because you can buy the whole market at, say, 5 basis points. But what kind of unintended consequences does that cause for governance in general is the question I worry about.
So what's the solution?
Well, I've proposed perhaps a pie-in-the-sky idea, but here's at least one attempt at a solution. So there are at least, I think, 250-odd companies in the S&P 1500 that haven't even beaten US Treasuries in the last 10 years. 10 years, okay, not 1 year, 5 years. So, and if you look at the proxy statements of these companies, the boards look perfectly manicured. They have these great skill matrices. Compensation, by and large, is standard, depending on the revenue of your company and so on. So maybe we need some new kind of investor, some like public private equity or someone who calls time on these companies, and maybe the capital involved in making all of them go private is like super large. Maybe that's the constraint. But somebody who will do something with these companies who are arguably becoming zombies. And there are exceptions like GE. Larry Culp came along and arguably released a lot of value, broke GE up into 3 units, and that was great. Much more of that needs to be repeated, and somebody needs to do that repeating, especially if boards are arguably, unengaged and arguably not accountable. Maybe that's this new thing called public-private equity. Somebody who, hangs around, forces some kind of reform, releases value, maybe goes public later or something else. Because as long as these companies are in the index and they underperform, and they are not good enough to get kicked out of the index, you have to ask the question, are we simply keeping some of these zombies alive? Are they getting capital that they don't deserve? Are we simply postponing the hard decisions that need to be taken in terms of restructuring and so on?
Yeah, it's funny you should say that. I was just with Ed Altman from NYU last week. And have you seen his research on zombie companies yet lately?
No, the bankruptcy types like Ed, I think, define zombie in a different way. I meant it in a more generic sense. So these are many of these are profitable companies. For example, IBM, right? It'll still pay you like a 4% yield on dividends and so on. But, I would argue many of them have effectively become corporate bonds. They're not even equity. So do you need the kind of PE ratios that they get? Do they deserve it? So I don't mean zombie in a distressed sense. I simply mean people who aren't probably paying cost of capital back, who are making accounting profits, generating some value, But the question is, I mean, IBM is a classic case study. It has underperformed the indices for like the last 10 years, 15 years, generates cash flows, but there are all kinds of issues. It's arguably the only value stock in technology, if you can call it a value stock. Had all the technology in the last three waves, like say mobile computing, most of us remember Watson and AI, and they were early in that. Cloud computing, but they missed the boat because of underinvestment. Amazon and Microsoft took off in cloud computing. AI, of course, the race is now lost to companies like OpenAI and Microsoft. So that's what I mean. A zombie in an economic sense, not necessarily narrowly in a bankruptcy sense. But I haven't seen Ed's research, and maybe there is a link.
Yeah, well, it's not as dissimilar as you think in that it's
Okay.
basically two definitions. One is they haven't provided cash flow to cover their debt coverage in some years, and two is they use his adjusted Z-score. But his point is it's very similar to what you're saying, which is there are a slew of companies in the developed world, Europe and the US, including S&P index companies and publicly listed companies where they're like zombies because they're not having sufficient cash flow to cover their interest. And actually, they're likely candidates for a restructuring or a bankruptcy, but yet they continue to somehow, I guess, raise third-party capital year in, year out and stay afloat. And I think it sort of ties into what you're saying. So anyway.
No, I think you're right. I think he's probably focusing on the left tail of my distribution.
Right.
So if he were to go right and I were to go left, the list becomes even longer in a distributional sense. Yeah.
Yeah, totally. Anyway, so what term do you think investors should be looking at? Like over what period? Like, for example, for you, I think 18 months is short term, whereas for me, that's a pretty decent term for a public equity investor these days anyway.
No, you're right. I mean, I didn't name the fund families involved, but if you look at some of the large fund families and you throw away the indexed funds and you try to understand how long does the average fund family or the mutual fund family hold a stock, it's probably between 12 and 18 months. Now you're right. As a trader, even if you want to use the word investor, maybe that's reasonable. I mean, who's to say what horizon you should hold stuff, right? You make that decision. I just worry that there is too much churn. Whatever decisions people make, when you aggregate that at the macro level, my worry is that there's nobody on the other side anymore. And effectively, these are companies being run by management. Boards are somewhat captured. Shareholders are disengaged. That's the problem I'm worried about. Now, what should the right holding period be? Who knows? I mean, maybe we have to discuss things like tax policy. Should the capital gains exemptions kick in at 3 years as opposed to 1? Maybe it's no accident that the holding period is like 12 to 18 months. So what should the right period be? I don't know, right? It's totally a function of the kind of investor you are. Maybe 12 to 18 minutes is good enough, right? Depending on your horizon.
Yeah. Based on what you said earlier, do you believe that private equity is therefore generally superior to public equity in enabling companies to best optimize long-term strategic behavior or performance?
Well, on paper, yes, right? I mean, they have to worry less about the classic quarterly capitalism problem. Horizons are somewhat longer. They have a defined exit event, right? In a classic DCF, which we teach in classroom, sometimes I wonder why we teach DCF. What does terminal value even mean? What does perpetuity even mean? So those issues kind of go away a little bit with private equity because you have a horizon like 6 years, 5 years, you get out. There are quite a few underperforming companies, even in the non-public space, which is what private equity is focused on a lot. So on paper, that's good private equity, right? But there's also bad private equity. There's like financial engineering, lever up the company, you do a sale lease back, get 100% dividend out. So there are those issues too. I mean, of course, with any innovation, there are good actors and bad actors. So the nirvanic hope, the ideal would be if we could replicate what private equity boards look like for public equity, meaning more carrots and more sticks is where I'm going with this, right? Because right now, my worry is that we have neither carrots nor sticks. So if you are on the board of, say, an S&P 500 company, you're getting $250,000, $300,000, which is good money, but good enough to make people interested, but not good enough to really make them work very hard or to piss the CEO off, right? And if you reframe this somewhat differently. 250, 300,000. If you're board ready, your wage is what, 1,500 an hour minimum, hopefully. So you're effectively paying these people for 200 hours of their time, which is like 6 meetings, 3 days, travel somewhere. Is that even close to enough? Do you have enough skin in the game if you're a director? No. With private equity, you have a bit more skin in the game, but you also have carrots. The other joke I often say and tell in class is that it's hard to get on the board of a public company. It's even hard to get off.
Yeah.
So you effectively have tenure for like 10 years. So that's the other thing that needs to change. Make the carrots and the sticks a bit like private equity, perhaps, would be one response to this problem. The long-term holding problem, I think that's probably never going to happen, right? I mean, passive in general is going to become bigger and bigger and stronger. The incentives for my ideal asset class to kind of get created are probably not there. So we're going to be in this limbo world for a while, unless something gets done. I can go on and on about the proxy process and how it's a clunky, inefficient way for shareholders to communicate with management. The easier thing to do is to just sell and get out. But if you are effectively an indexer, which is what most people are, closet indexers or otherwise, you cannot sell. Then you get into some performative engagement occasionally, which usually doesn't move the needle of anything. And it's just a series of bad equilibrium.
So it sounds as though you're very much espousing activism here and the case for activism. Is that right, or do I misunderstand?
No, I fully agree with you. I mean, I often say that there are only two actors that keep us somewhat honest. The short sellers in terms of overvalued companies and the quote unquote activists. I don't mean social activists, like the shareholder activists like Elliott or Nelson Peltz and so on. And if you have a system where you get rid of them both, and society doesn't like either party, right, for all kinds of reasons, then you get a bizarre world like, say, Japan or something, where nothing moves for a long period of time. You need somebody to disrupt the equilibrium and push people to be somewhat honest. Otherwise, you'll have an autopilot mode of operations where the investor doesn't care, has a 12 to 18 minute or 18-month window with the stock, doesn't like it, dumps it. The index maker argues that it is not his or her responsibility to worry about governance. Management carries on in its merry ways with all its consultants, board matrices and comp consultants and blah, blah, blah. And you get these strange worlds where 250, 300 companies in the S&P 1500 have not even beaten what T-bills would have made, for instance.
I think you have some investment management firms that are doing what you're espousing in the public markets, both hedge fund and long only. But I guess what you would contend, and you correct me if I'm wrong, is that they're too few, too small, too immaterial in the context of indexing and quant. Because you have like the AQRs of the world who are sort of long only with some hedge funds. You have the David Einhorns of Greenlights of the world. And, we could name multiple other value investors. And obviously, we both know what's happened, which is for many years they'd underperformed. Last few years, they've outperformed. But over time, the net is their assets have diminished, and obviously we know what flows have been for ETFs passive. It's
absolutely fair. Very few of them show up in the so-called top 3 or even the top 6 of companies. And I'm not saying you need to be a top 6 owner to have influence, but these are few and far between, right? I mean, if you look broadly, the so-called shorts have not made any money. The long only types like AQR, I haven't studied them carefully, but how involved are they in forcing the company to create value? I'm guessing they are not, but I don't know. David Einhorn, of course, has been hugely involved, but I'm sure you've listened to his amazing podcast on Masters in Business, where he basically says that the only way he makes money these days is share buybacks. As long as they return the capital to me, I'm happy. There's nobody on the other end waiting to kind of release the value that I see in terms of informational arbitrage, the stuff that we've learned in textbooks, the classic Chicago school model of informational efficiency and so on. Yeah, few and far between, not enough. And what is going to reverse that trend? Perhaps nothing. That's why I'm complaining a bit, I guess.
No, that's fair. And now, look, I think you're trying to improve the capital markets and capital allocation and not have the U.S. end up like Japan as a zombie market.
That's the hope. That's
with a
the goal.
with a misallocation of resources. And if anything, Japan is trying to finally converge 35 years later to where we are with corporate governance reform and activism. Do you have a view on that?
100%. I fully agree. And some of the things that are coming out of the Japanese stock markets are amazing. I keep sending emails to my co-authors that we should look into this. So the exchange says things like, you should improve ROIC by blah. You should do this. You should do that. So you're right. They're effectively, repeating our textbook in some sense, which is very heartening in one way. And let me tell you where my frustration started and why did I even get here, right? So I'm an accounting professor, and the thing that always worries me is that does anybody read a 10K anymore, right? So the average passive guys basically have no money to do research. We are all in love with technology. People are running some AI models or whatever on proxy statements and 10Ks. I'm not sure how good they are. And then it occurred to me, it's disengagement not just with the 10K, it's disengagement in general. In general, forget the accounting and nobody cares about 10Ks and so on. I'm not sure what people care about anymore if you're an investor. And I often joke, the SEC claims that there's some bizarre 40 trillion assets under management that cares about climate reporting. I'd be happy if 1 trillion cared about what shows up in a 10K. So this larger point of disengagement for me started with disengagement with respect to the simple things like 10K, which I worry about as an accounting professor. But going back to your Japan point, I think it's heartening, right? In some sense, we need to somehow make it easier for activists to do their thing. Now, granted, there are issues. I mean, they are highly levered and they tend to go after targets that are easier to fix. Like Disney, you have a streaming problem and you should look more like Netflix. Or Apple, you have too much cash, pay me the cash. So they have horizon issues too. And hence my IBM problem. IBM has 250,000 employees, lots of IP from which they make money, generally an underperformer. Maybe it's even hard for an activist to figure out what to do with IBM. Partly because it's not a quick fix. It's not going to get resolved in 3 months or 6 months. Hence my earlier comment about some kind of public-private equity, which has a longer horizon. I'm just writing down an ideal model. Okay, I don't know how to fund it. I don't know whether it makes economic sense for somebody to even do all this. And maybe somebody will come up with some better structure. But but you're right. The Japan model is converging to our model after a very long time. I mean, there are other issues with Japan, right? I mean, they kept their banks alive longer than they should have. The write-downs weren't taken, the real estate loans. Thankfully, we don't do those things, which I'm happy about, because it's better to take the write-downs early, better to not keep subsidizing banks and companies that don't deserve capital.
My view is that's our next crisis, commercial mortgage real estate at the banks and particularly the regional banks. But that's a side story because that, to take the amount of losses would have a material impact on equity, which would in turn diminish valuation, stock prices. But that's another story for a later podcast. Regarding what you did say, I mean, part of the problem, I think, is, again, and I mean, maybe this is all a bit circular, unfortunately, but if we look at the constituents, to your point, passive doesn't have the capital or ability by definition to read 10 Qs or Ks because they're supposed to be passive. And then the quants, well, nominally they're reading them with machines, but they are arguably either the machines are figuring out what to care about or the humans are telling the machines what to care about. But to your point, yeah, it's not like when I was a PM at Soros, when I graduated Columbia Business School and I was sitting there literally like Buffett or whomever reading 10 Qs and Ks, printing out on paper at midnight, reading Qs and Ks. The problem is the human discretionary investors, other than a few, you can't compete in terms of it's faster, cheaper, and quicker. Well, that's redundant. It's faster and cheaper to have a machine read the Qs and Ks.
Assuming the machine knows what it's doing, which I seriously doubt. I often joke in our world, we don't even have manual intelligence. Right? Forget AI. It's artificial intelligence. But you're right. I mean, you're absolutely right. Can you generate more wealth than what machines do? Maybe not. But I guess the thing I keep beating my drum about over and over again is that this has unintended consequences at the macro level for governance. Maybe less for asset pricing. Maybe indexing, people have argued, indexing has no major impact on asset pricing. Perhaps true. But I can tell you it has an impact on governance, right? And and since you claim that, part of the podcast is a little bit about E, S, and G, I think people have given up on G because G is so bloody hard. G is hard. Boards are very hard to fix. Management is hard to dislodge. The proxy process is a bit of a mess. The indexers are super important, the index makers, except in my view, they don't have much accountability, right? Maybe the other solution to some extent is maybe we should start pushing the index makers to worry about governance, for instance. And they did a little bit, as you know, S&P with dual class shares and so on, but they backed off. So you're right. Machines are probably better, more powerful, but it's creating unintended macro consequences.
No, I don't think it's that. I just clarify one nuance. I don't think it's that people have given up on governance because it's so hard. I think there's an asymmetric information thing where that, but I think you're doing a good job spreading the message that there's this issue. But I don't think it's much easier to debate global warming and see it and agree or disagree or have a political view. Like the governance, it's not, governance isn't causing forest fire. Well, again, some would say the global warming isn't causing forest fires and it's part of the natural cycle. But anyway, in other words, governance isn't raising sea levels, causing fires, creating natural disasters, causing insurance losses. Governance is like a slow burning fire in the background that's not significant enough to really spark any attention.
Excellent, Mark. And one more asymmetric idea here. People worry about governance when things go wrong. People don't worry about governance when things are going well. Is Tesla a well-governed company? That could be a whole separate podcast. But as long as the stock price is going up, very few people care, unfortunately, right? And the other thing about governance, going back to you touched a little bit on the politics, governance should be bipartisan. I mean, how can anybody be against subsidizing companies that don't deserve capital, whether you're a Democrat, Republican, Libertarian, whatever, right? So I think that's an opportunity, even from a political standpoint, to kind of refocus some of the debate on ESG, which I'm sure you've discussed before. Yeah, let's worry about governance. There's no conversation here about politics. We're just trying to kill fat cat companies that don't deserve the capital that they get, reform them, make it easier for shareholders to have a voice. How can anybody be against these things, right?
Well, but then I think it does get back into politics, right? Because these big, quote, fat cat companies are the ones who are donating and have lobbyists and donating to political parties, and they don't necessarily want reform. So you have that principal agency conflict, right?
100%. We should talk a little bit more about the S in the ESG. A lot of the S, I think, should be about citizenship and political lobbying. So I have another paper where I show that the payoff to $1 of lobbying is at least 10x. So the payoff to maybe R&D or even AI, maybe like 3x. Arguably, we have underinvestment in lobbying. You should lobby more. Who cares about R&D? It's anyway more entertaining to take a senator out to lunch, right?
When did you write that paper? Remind me.
I'll send it to you. So, because I've always been worried about this lobbying issue. The payoffs are massive, and it's not that difficult to think about this, right? So, maybe a $500,000 contribution to a political campaign can easily fetch you, what, $5 million in returns? It's nothing, right? So that's the other issue that you raise, the issue that we have in our political system, where there's very little transparency in terms of who gives how much, why, what kind of positions were taken. That's another interesting problem. So many of these are, kind of baked into budget passing procedures. For instance, I think there is a rider that if the SEC were to ever ask public companies to put out information about political lobbying, one of the parties will not pass the budget for the SEC, which means you can't make payroll, blah, blah, blah. There are many such examples which I've written about, which I'll happily forward to you. So I think you touch on a super important point, that lobbying. Again, what does lobbying do? Creates crony capitalism, right? There's a distinction between pro-market and pro-business.
So what's the solution?
Well, it's at least some more transparency. And you could argue that lobbying has existed since times immemorial. Access to the king's courts is obviously super valuable. It's never going to go away, right? We can minimize and probably reduce it to some extent. But the other worry, of course, is that it will simply go underground. But that's okay. Make the cost of being a crony capitalist higher. That's all we can hope to do in the short run. Push for some more disclosures on corporate lobbying, because right now it's a bit sketchy. It's much better here than it is in, say, Europe, which is the other thing that kind of cracks me up sometimes. Europe is big on ESG, but I ask them, how come I don't even know what holdings your mutual funds have? How come I don't know anything about lobbying? Because they're kind of weird in some sense. On the one hand, there's a lot of push towards transparency and, SFDR and whatever. On the other hand, basic bread and butter stuff is as opaque as it is here, arguably more opaque, especially in the lobbying area.
Well, I'll tell you another funny one. There are some European pensions that are supposedly huge on ESG. And for example, I find it somewhat hypocritical that they'll own A, B share classes, which are many and most of the large tech IPOs within the last X years, 2 decades.
It's the classic trade-off, right, Michael, between values and value. And it's good to have this conversation in the open. There's no free lunch. Part of the problem with the left, the political left, was they said doing good for the world is good for shareholder value. To a limited extent, but not true. There are trade-offs. And the political left wants to live in a trade-off free world. Somehow you can get this and that. You can get values and you can get value. No, not really. If you care about shareholder democracy, then you shouldn't hold dual class shares. But maybe dual class shares are okay in certain circumstances and not okay in certain other circumstances, right? So the whole short-termism issue that we've been talking about, maybe dual class shares help you, vaccinate you or insulate you a little bit from what the market thinks. But after a while, maybe you need a sunset clause. Maybe you can have dual class shares, I don't know, make some number up, 7 years, 10 years. After that, they should just go away. That would be one way to deal with this issue, because the company now is reasonably mature. It has to, arguably play by the standard rules of the game, etc. Because there's another issue with dual class shares. As you know, founders tend to overstay their welcome with companies. Many, many examples, right? It's very hard to know when to leave. Most people tend to stay longer than they should. And this dual class mechanism makes it a bit easier. Europe has another version of this. It may not be called dual class, but a lot of the families are effectively own companies through foundations. Mm-hmm. So the foundations are effectively shills for the families. And after the first generation passes on, the temptation is strong to kind of view the company as an ATM machine. So just keep giving me dividends. We'll worry about innovation and all that later. So, Europe has an innovation problem. I often say, how many times have we heard of a European Uber, Amazon, Microsoft, Google, Tesla? None, right? So their governance code, their systems evolved differently because of the war, because of, the code law, common law differences. And the other thing which I've realized of late is that most of the share owners in Europe are institutions, unlike here, where most of the share owners are individuals. So governance and ESG is inherently political here, not surprisingly, right, relative to there, because the average person doesn't really have much to do with capital markets, I would argue, in Europe, relative to here, where we have Robinhood and lots of things. Individuals are significant owners of equity here, and maybe that's why ESG is more political here than there. Is one theory.
Interesting. Aside from what you've discussed, which has been immensely insightful, any advice for allocators or investors?
Take ownership seriously. Be
That's
engaged.
Good advice. Yeah.
Seriously, vote. This is like democracy, right? We complain about it till we don't have it. Exercise voice. Try to engage with the company, and call people out. For instance, what about all these zombie companies? For instance, can you do something, right? For instance, should we maybe going back to your asset pricing idea? I'm no financial engineer, but is it possible to perhaps create an S&P 1500 minus these zombies? I'm guessing it's too difficult to kind of create that index or to individually short these 245 companies. Shorting is expensive anyway. So some kind of financial engineering idea might be an idea, right?
No, all of what you say is viable. I would say you're being too self-critical. All that's viable. In fact, I suspect there's probably significant alpha from it.
Yeah, and let me give you one more idea. Again, pie in the sky, but that's my job as a professor to kind of dream of a world that doesn't exist, right? So think about say the S&P 1500, the proxy process, right? Let's take the top 100 asset managers. Big companies have lots of money, hopefully to do the research. So I've written a piece, take the 1500 most liquid companies in the world or maybe in the US, split that among the top 100. Each of you does research for 15 companies and publishes that on some kind of controlled wiki kind of model so that others can benefit from your research. This is not a world where this is not like trading, meaning if you become rich, then I lose. Everybody becomes rich. Just do the research for 15 companies, each of you top asset managers, multiply that by 100, you have the top 1500. You have a far more informed view on governance than necessarily kind of consuming what ISS and Glass Lewis tell us, right? Because it's a classic collective action problem. Now, who will run this? I mean, get an academic to run it because we don't have as much in terms of conflicts of interest related to somebody else. So anyway, something like a proxy wiki page, which will make the whole system better. Fix the proxy process, lobby for that. It's such a bizarre way to communicate with shareholders, to kind of come back to my earlier point. Because the way this works, as you know, is you can never file a proxy proposal saying you as a management suck. For 10 years, you've not given me even treasury bill returns. What the heck are you doing? Because that's considered micromanaging the company. And then the SEC will throw that out. So by definition, the proxy process is almost hardwired to only pick up what you might think of as frivolous issues, quote unquote frivolous, right? Like scope 3 or not, plastic or not. Because it's hard for shareholders to complain about the bread and butter stuff. This is a bizarre system. I was just thinking about this. The other issue is, why does the SEC have to micromanage proxies? I just don't get this, right? When we complain about how proxy advisors may not have the expertise to deal with governance issues in 4,000 companies in the US, does the SEC have that expertise? And why have you taken on this job? I don't get it, right? I mean, to get this no action letter, as you know, you have to go through the SEC. Could the top 5% of the shareholders or 5% shareholders perhaps do this? Isn't that true shareholder democracy? I don't know. There are many issues we can discuss in terms of the plumbing of how our governance system is set up. The other problem, right? How come shareholders don't appoint directors? As you know, directors appoint directors. The CEO appoints directors, which seems bizarre to me, right? Why is the top three, the BlackRock, Vanguard, State Street, not involved in important issues like appointing auditors? That's the one resolution that gets passed by like 99.99% all the time, right? So there are several questions one can ask, and if you're passive, this is the other point, Michael. The cash flow rights and voting rights are commingled, correct? Meaning, if you're BlackRock, Vanguard, State Street, you love the cash flows that come from owning these companies. You may or may not have a comparative advantage in dealing with voting because it takes research. Why not split that? Perhaps, I think they're kind of doing that right because they start, they make a fair amount of money by pledging shares out or share lending. So in some sense, you are decoupling the cash flow rights and voting rights. But that's another idea. Just sell your voting rights if you don't have the expertise to monitor companies.
Well, wow. You and I could do a series of we could do a series of podcasts where, like, the courses you teach at Columbia or the papers you've written on all of this. I mean, I think you've given a ton of great suggestions and reforms that would substantially improve the governance and shareholder returns in this country.
Well, that's my hope, because much as I love India, I often tell my students, when you ask for socialism, you don't know what you're asking for, because, if you have complete stakeholder capitalism, you get neither mission nor profit. I'll be happy with one of the two. For example, there are lots of, state-owned public enterprises in India which have burned tremendous amounts of very scarce taxpayer money. So that's why I just, almost reflexively look for efficiency. Partly, I guess we are all victims and or products of our upbringing and background. And I'm glad you made me say that earlier. That's at least some insight behind my, intellectual orientation.
Super interesting. On a lighter note, any books you've read lately or books favorites or anything you recommend to our listeners?
My Kindle library is like full of so many books that I've bought, but I've meant to read, but I've never finished. But one idea that comes to mind, maybe Nassim Taleb's books, some of them are great. I mean, most people talk about the Black Swan. I would say the Bed of Procrustes. I'm probably mispronouncing this. So it's a bunch of aphorisms, and they're amazing. They're really, really deep. And I occasionally steal them for use in classrooms.
Nice.
So that's one simple book that's good to read, but a big ROI on time. Plus, there are so many good podcasts. I listen to Econ Talk. I don't know whether you've listened to that by a professor called Russ Roberts. So
sure.
Absolutely fantastic.
Nice. Okay. On that note, Shiv, we'd like to thank you for the super interesting discussion, sharing your most valuable asset with us, your time. We hope listeners have a better appreciation for one of the more thoughtful professors on governance is thinking about and how we could all benefit from this as investors and allocators. This is your host, Michael Oliver Weinberg, hoping you join us again for our next episode, where we'll speak with another thought leader who will provide insight on improving alpha via innovation.
Thank you for joining us on the Improving Alpha Innovation in Investing, ESG and Technology podcast, presented in partnership with Vidrio Financial and sponsored by Alternatives Watch and PEVC Tech. Vidrio Financial offers a cutting-edge data management solution that not only collects and cleans your data, but also empowers investment teams to cut through the noise and extract valuable insights for better decision-making in areas such as valuation, risk assessment, and portfolio management. If you're an endowment, foundation, pension, sovereign wealth fund, asset manager, OCIO, or family office facing challenges with your data pipelines, we invite you to connect with us today and explore how Vidrio can seamlessly integrate with your investment team to enhance your data management capabilities. The information covered and posted represents the views and opinions of the guests and does not necessarily represent the views or opinions of Vidrio Financial or our host, Michael Oliver Weinberg. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding investment planning.